I'd just like to do a brief review of key accounting concepts. Everybody's at a different level with accounting, and some of you may have been very, very familiar. Others of it may be a little bit since you've taken your accounting basic classes. So what I'm going to do is do a brief review of accounting. It's very brief, and it's intended as a refresher. Now, if you've had me for Finance 311, we've probably have gone through this. But this is always good to go back to the basics. Again, we've seen this before, but financial reporting is about putting information out there to the public, to users, to make decisions. It includes financial statements and other types of reports. Then we move into financial statement analysis, where you're using financial information that was produced to assess prior performance, look at strategy, and likely what future performance may be. And we talked about capital allocation, we talked about issuance of debt, granting of credit, equity valuation. So when we really think about it, the basic elements that go into financial statements are operating, if you think about it. The company sells products or services to generate revenue. They incur expenses while generating revenue. So that's what we'll call the operating part of the business. Now, a lot goes into what is revenue, how does a company make money, which we're going to get into. But remember, we want to think about it as this is an operating activity. Revenue and expenses from producing goods and or services. Then there's investing, and that's what are we going to do to invest in the future, whether that be equipment, purchases, buildings, acquisitions, investments, whatever we're doing to build the business. That's called investing. So that's really the asset side of the balance sheet. So the revenue is income statement, assets, the investment. Then there is financing, borrowing from creditors, that creates a liability, is selling an ownership interest, equity, to the shareholders. So financing is how are you paying for all of this. Financial firms use financial reports to communicate about these activities, tell us what's going on. So but I want you to start thinking in this business activity perspective as opposed to just the accounting. Now, when we come back, you start with journal entries and adjusting entries. These are the process of how entries and data is input into a system. You get into the general ledger system. And remember, debits have to equal credits. Biggest error that people make in accounting is debits equal credits. For every debit, there's always a credit. So understanding what both sides of a transaction are is critical. You can't just look at one side of a transaction. Understand the other. Then we get into a trial balance, which takes all of this, the accounting input data, puts it into a ledger. We then examine the different pieces, make adjustments, and then financial statements are produced. So these are sort of the stages: journal, ledger, trial balance, financial statement. But think about the flow of information, because as we want to gather information, we oftentimes have to go back to that journal entry. What happened? So the key elements, and this should not be new to anybody, general terms, assets. Those are the economic resources of a company. These are items that can be used in the future. They represent a future value of some sort, whether that be cash, accounts receivable, inventory, prepaid expenses, property, plant, and equipment, intangibles, goodwill, patents, all sorts of things. But they are economic resources that will be able to contribute in the future. Liabilities, on the other hand, are claims on those resources. Okay? Revenue is the inflow of economic resources, cash. Wherever we see economic resources, think about cash. Expenses is outflow of economic resources, think cash, or increases in liabilities. Financial statements are constructed using these basic elements, these 5 elements. Okay? Accounts, within a system, we label accounts. so that we know exactly what it is. Now, when we get to financial statements, a lot of these specific accounts are summarized into higher level accounts. At times, we need to go back and disaggregate some of this so that we can understand what is happening, what's normal, and what may not be a normalized recurring expense from an analytical perspective. That's where we talk about, we'll get to this, normalized income, often referred to as non-GAAP income. In the asset accounts, we got cash and cash equivalents, accounts receivable, prepaid expenses. Prepaid expenses, remember that if I pay my auto insurance today for the whole year, that is going to benefit the subsequent period. Inventory, that can include raw materials, work in process, finalized inventory, property, plant, and equipment, investment property, which can be physical, it can be securities, intangible assets, and then financial assets. So they can go into the asset category. Then there's liability accounts, trade payable, debt payable, and bonds. Again, we break this down into short-term and long-term. Those due within a year, those over a longer period of time. Now, assets and liabilities, you look at this and say, assets might be, if it's a bank, has a loan receivable, the borrower has a loan payable. So if you think about this, I want to keep going back to debits and credits. So when a bank lends money to a borrower, it creates an asset for the bank, loan receivable, and a liability for the borrower. But if we go back to the borrower, the entry would be debit cash, credit, loan payable. Then we have equity accounts. And equity accounts have a number of components. Capital, such as common stock. Oftentimes that's listed simply as a very simple number. It doesn't necessarily represent cash that came in. So they could be a par value of 10, all different numbers there. Then additional paid-in capital. So capital is often, it starts as common stock with a value, and sometimes when you sell equity, you will then end up with additional paid-in capital. So the top two are the capitalization of the company. Then there's retained earnings. These are earnings that the company has not distributed to shareholders in the form of dividends. So each year the earnings come in, they add to the capital of the firm unless the firm pays it out. Then, in a true accounting sense, we got to throw another one in here. Accumulated other comprehensive income, which is net income plus some adjustments. Let's take a look at Apple here. And I know these dates are outdated, but it shows the piece. Here in shareholders' equity, there is common stock, no par value, 1,800,000 shares authorized, 929 and 915.97 issued and outstanding in each of these periods. So what you see is they did issue stock. Most of the stock that Apple issued during this period was to employees under stock compensation plans. And we can see each one of them, what they are. There's still room to issue more shares. Then there's retained earnings, which is 62,841. That's the income that they have not passed out. And then there's accumulated other comprehensive income loss. A lot of this from hedging and foreign currency translations. And that gives us our total shareholders' equity. So when we refer to total shareholders' equity, don't forget it's the whole thing. So it's common stock, retained earnings, and accumulated other. It's not just common stock. It's the total. And we have the basic accounting equation. I already told you debits have to equal credits, but assets equals liabilities plus owner's equity. This is the equation that underlines the balance sheet, but it reflects the company's position at a point in time. Okay, key to remember, this is a point in time, and since we use the cost basis for most things, it may not equal the market value of the company. So if we look at it, assets equals liability plus owner's equity, we could also look at it in the same way, assets liabilities equals owner's equity. What do we have in revenue? Well, we have sales. We have gains on the sale of fixed assets or other things that are not part of that operating cycle. We can have investment income. That's part of the investing cycle. Then we have expenses. Cost of goods sold. What is it costing us to produce them? General and administrative costs. Depreciation and amortization, non-cash. Interest expense, tax expense. Losses, no. We could, but don't focus on that. Financial statements. What are the basic financial statements? I took a look at them briefly when we were going through the 10K, but the first one is our statement of financial position, also known as a balance sheet. What you're going to find is each company may use slightly different terminology, okay? So it becomes important to know what we're looking at. Statement of financial position, balance sheet, statement of assets and liabilities, and shareholders' equity. So there's both. Then there is comprehensive income, statement of changes in equity, so we know what happened with equity, statement of cash flows, then the notes. Okay, so really this, in my mind, summary statement of cash flows is one of the most important. Everything is, but I like to really focus on the cash that comes in, and you'll see why as we move forward. We talked about this, they're a point in time. Here's a sample, but they all tie together. So if you have net income, here's the income statement. The net income here drops down to statement of retained earnings, which end up at the retained earnings. It moves its way down here. So we start with the beginning, we add the 200 in, and then the 450. So think about that, they're all connected. So think of the flow, that link. Income statement and retained earnings, you can see it, here's the beginning balance, net income less dividends, each ending. So again, we see this flow through to the balance sheet, statement of position, and the statement of retained earnings. So one, think about linkages between the different statements. Ending balance sheet, you can look at that. The accounting system is based on the accounting equation that we talked about. Assets equals liabilities plus owner's equity. As each transaction is recorded, the equation remains in balance. If you don't know what it is, you got to look at it. So every transaction runs through this. It goes through the owner's equity either as an income item, revenue or expense, or it comes through a liability. You want to make sure it's always in balance. And this we don't need to get into. Subtotals here provide useful information. Okay, we operate for the most part, the firms that we're dealing with, on the accrual method of accounting. That contrasts with the cash method, where revenues and expenses are recorded when they are received or paid. Okay, so we use the accrual basis of accounting, where when we earn the revenue is when we recognize it, not when the cash comes in. So we would set up an accounts receivable. We're going to look at this as ASC 606 once we get going. Same thing with the expense. Sometimes we incur an expense, but we don't pay for it until later. Other times we may pay in advance, and it benefits a future period. So we need to adjust for these by having accounts receivable, accounts payable. So we show the income statement on a accrual basis, where we're back to the matching principle. We're trying to match revenue with the period in which it is earned and match the related expenses. Here's an example. We don't even have to look at that. Accruals, revenue. Sometimes we get cash in advance before we sell something, so that's deferred revenue. Entry would be debit cash, credit unearned revenue. When we actually earn it, we'd reverse that. We would debit deferred income, and we would credit income. So cash movement the same as accounting period. There's no accrual entry needed. But the cash movement after accounting recognition, this is the unbilled revenue, we do the reverse. So this is the accrual process. It depends when cash moves. Prior to the recognition of the event, at the same time as the event, or after. Okay? Same thing with expenses, prepaid expenses. Here, settled transaction, same period, nothing. Cash movement after, accrued expenses, because we want to match. Here we can see basically a consolidated statement of income. You see it's broken down by what's meaningful to the company. Okay? Net sales, costs and expense. Every one of our companies that we're going to look at are going to have things that look like this. But the thing that we want to look for, this is a normal, but this is sort of unusual. Okay? So we really want to understand what that is as we go forward. We also are interested in seeing how net sales and cost of sales relate to each other. Statement of comprehensive income, also known as income statement, statement of earnings, or profit and loss statement. Those are all items that affect owner's equity, but are not the result of transactions with shareholders. Comprehensive income, net income plus other comprehensive. We can do a single statement, or we can do two consecutive statements. That's a variation that under GAAP we can do. Net income equals income minus expense. It's always shown for a time period, whether that be quarterly or whether that be annually. Not every company has a calendar year December 31st. Sometimes they have earlier ones. Here's just a little bit sample of statement of comprehensive income. You can see it brings in net income, but then it brings in hedge accounting, brings in unrealized gains or losses on sale of financial assets, and currency translation. So we actually start with net income. When we get to comprehensive, it's a different number because of some adjustments that we don't record under GAAP or IFRS in that, but we specifically do it in comprehensive income. We just got to be aware. Okay. Changes in equity, statement of changes in owner equities or statement of shareholders' equity. Again, it's a period of time. Okay. Beginning equity plus changes in equity equals ending. We break down that change. The change can come from issuing new stock, repurchasing stock, net income less dividends plus other comprehensive income. This is what the consolidated statement of stockholders' equity looks like. The total number, and then it breaks it down by category so we can see what it is, what happened from one year to the next. It can be very helpful, but we got to start to think, where does this tie into the cash flow statement? And as I started this discussion, we want to look at things, start thinking things in operating, investing, finance type activity. They're very distinct things. Operating is what the business is doing. Investing, think future. Financing, how we are paying for things. That includes debt, and that can be debt taken out, debt paid back. Here's an example again. Portions admitted, yep, net cash flow provided by operations. We'll actually go into a little more depth. When we see cash flows provided from, used by, they made capital additions, they capitalized some software, they sold some licensing, so that is a non-capital item. That's not an operating. When you sell capital assets, that provides cash. So in this case, the operations provided $580 million. They used $333 of it for investing. We move our way down, is financing used $438. So what they did is they borrowed more money, but they paid money back. They paid dividends. There was exercise of stock options. This is the compensation to the executives, and they repurchased common shares. So they spent $438 million. So if operations generated $580, net cash in the investment side was $333, outflow, then the 438 outflow on capital, cash actually went down. And we see that here. We want to see how the cash runs. Very important statement as we move forward. Accompanying notes, oftentimes referred to as footnotes, and they accompanying the financial statements are an integral part of the statements. They define specific accounting policies and practices, details about line items that are on the financial statement. So what they'll do is if there's a line item on the financial statement, especially on the balance sheet, it defines the accounting that goes into it. So what you can do when you do that is notes and disclosure is for analysts. Okay, so what we're going to be doing. So we want to understand what those choices are, and are they consistent with what we've seen in that industry. And sometimes it's a detailed schedule type notes. When you look at, here's their note 7 on property, plant, and equipment, and they tell us where they started on land and buildings, machinery, other, construction in progress, and total. And we can see what happened both on the asset side and on the depreciation side. So that's just a way of looking